Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, it's been another jam-packed week. What's the biggest headline for you?
This week felt like we entered Act 2 of the Trump tariff saga, but with a legal twist. The headline? An appeals court just gave Trump's executive tariff order a second life. But this isn't over. In fact, it's just beginning. The case is now on the fast track to the Supreme Court. So we're not just talking about tariffs anymore. We're talking about the future of executive power over trade policy. If the highest court backs Trump, we could be looking at a permanent expansion of presidential authority over international commerce. That's a structural risk, and markets know it. You can already see the ripple effects. Japanese equities have been bouncing around like a ping pong ball for 3 straight sessions. Investors are trying to price something you can't model, legal risk wrapped in political volatility.
And on top of that, we had a surprise from the budget bill, right?
Exactly. It's not grabbing headlines yet, but it should. Buried in the latest U.S. budget bill is a clause that allows the government to unilaterally tax individuals or companies from countries it deems discriminatory. What does that mean? In Trump speak, it could be anyone, and that's the danger. If you're a foreign investor holding U.S. assets, bonds, real estate, equities, this adds a new layer of political risk that wasn't there before. It's subtle, it's technical, but it's powerful. Because for the first time, we're seeing Washington inject geopolitical judgment into tax enforcement. It's yet another reason why global capital might start thinking twice about U.S. exposure.
Let's turn to NVIDIA. Massive earnings beat, but some big caveats too.
Absolutely. NVIDIA delivered the blockbuster we expected, $44 billion in quarterly revenue, with $39 billion from the data center division alone. But here's the catch. They took a $4.5 billion write-down on unsold H20 chips and flagged a potential $8 billion hit in Q2 from export restrictions to China. So the message is clear. AI demand remains insatiable, but geopolitics is starting to bite. The company's China exposure, once an advantage, is now a liability. Still, the market shrugged it off. Shares rose 3% after hours. Why? Because the growth engine, the AI infrastructure build-out, is just too powerful to ignore, at least for now.
Speaking of powerful forces, what's the Fed telling us this week?
The Fed was crystal clear. They're not moving. No cuts, no pivot. Just steady hands and hawkish undertones. Their May minutes flagged persistent inflation, growing stagflation concerns, and, this is new, an explicit warning that the U.S. could lose its safe haven status if the trade war drags on. That's a red flag. And recession talk is back. Fed staff are now projecting elevated unemployment through 2027. But even with that gloomy outlook, they're not cutting anytime soon. Bottom line, the Fed isn't blinking, and unless inflation collapses or the labor market breaks, they're staying put.
There was a bit of optimism midweek, though. What was behind the market rally?
That's right. On Wednesday, we got a rare combo of relief and resilience. First, Trump delayed his 50% EU tariff hike until July 9th. That helped ease near-term trade anxiety. Second, U.S. consumer confidence finally bounced, snapping a 5-month slide. The expectations component jumped 17 points, showing a shift in mood around jobs and income. And let's not forget, NVIDIA's earnings helped lift tech. All 11 S&P sectors closed in the green. It was one of those rare days when everything just clicked. But here's the thing, that optimism is fragile. We're still dealing with courts, tariffs, and central banks stuck in neutral. This rally felt more like a pause, not a pivot.
You've talked about bonds being the quiet storm. What happened there this week?
Bonds had a fascinating week, especially at the long end of the curve. U.S. 30-year yields dropped 8 basis points after Japan's bond market started wobbling. A weak 20-year JGB auction, lowest demand in a decade, forced the Japanese Ministry of Finance to reconsider how it issues debt. They're now thinking about scaling back super long bonds and shifting to shorter durations. Why does that matter? Because Japanese life insurers and pension funds are some of the biggest buyers of U.S. treasuries. If they change their strategy, U.S. yields will feel it.
That's it for this week. Stay tuned for more insights next time.